Welcome to the Strategic Investor. Join us as we interview some of the world's most productive asset managers and uncover sophisticated and unique investment strategies in the markets. Here is your host, Charlie Wright.
Hello and welcome to Strategic Investor Radio on OC Talk Radio, where we bring you investment strategies you are not hearing elsewhere. Thank you for joining us. I'm Charlie Wright, and we have the privilege of having our guest today, Ray Sturm, co-founder and CEO of AlphaFlow. They provide income-producing real estate loans to investors. He speaks to us from their headquarters in San Francisco. Ray, welcome to Strategic Investor Radio.
How you doing, Charlie? Thank you for having me.
So, Ray, you've got a JD MBA from University of Chicago. You worked with Bear Stearns and Lazard. Now you're a leading entrepreneur in what we all know as fintech. You founded Realty Shares, one of the industry's top platforms for real estate investing. And by the way, they were a previous guest of ours 2 or 3 months ago. And now you have AlphaFlow, and you offer personal portfolio of real estate loans that are professionally managed. So give us a brief background of yours and AlphaFlow, and make it brief, will you?
Absolutely. Thanks, Charlie. So as you mentioned, I co-founded Realty Shares, which was one of the first real estate crowdfunding platforms. And crowdfunding in general, really what was interesting about it is we took the amount of dollars needed for investors to get into this asset class, and this asset class being real estate loans. We brought it down to about $5,000, and that was a huge step. AlphaFlow really came from that experience where a lot of our investors said, this is great. I like the returns. I like the risk profile, but I don't want to do all the work myself. So we launched AlphaFlow as an asset manager to really take that work off of investors' hands and said, we can go and we can build you a diversified portfolio ourselves. And while we're at it, we can use institutional level of analytics to actually pick the loans out. And that's AlphaFlow today.
So describe for us your strategy and your investment model, will you?
Absolutely. So we don't originate loans ourselves. We're not the lender. What we do is we partner with lenders around the country. And so those lenders are working directly with borrowers, and our view is very much that lenders have the best expertise on their local markets. They know what's happening. If we're speaking to one of our lenders in Cleveland, they know which neighborhoods are up and coming and which ones are going down. So what we're doing is we're coming in and working with those lenders. We look at the loans they've already made, and we're actually purchasing some of those loans off of them. And what we're talking about here, Charlie, is all real estate bridge loans. So think fix and flip loans. These are pretty short term. They're 6 to 12 months. They often earn 8 to 12% interest, and we're building an inventory of those. We then work with our clients who come to us, and those clients are everything from individuals like me and you to actual institutions like university endowments or hedge funds. They come to us, and we build them a portfolio of loans around the country. Typically, we're talking 80 to 90 different loans spread across 15 to 25 different states around the country. So you're getting something very diversified, you're getting a great return, and you're getting something that's really backed by actual assets, houses. So if one of these loans defaults, there's a house behind it. And that's a great return for investors these days.
So who are these lenders? They're obviously not banks at 8 to 12%.
Correct. Yeah, so in the industry, you might hear them called as hard money lenders, specialty finance companies, alternative lenders. But these tend to be very local shops. These aren't huge establishments. And these are lenders that are they're doing loans that banks don't want to do. And if I could just address one misconception. So oftentimes when people hear you can't go to a bank to get a loan like this, they assume it's because these guys have bad credit. That's often not the case. Really, banks don't want to touch these loans because they're too short term. You're talking 6 to 12 months, which means they can't offload them to Fannie and Freddie like they do with most traditional mortgages. So they've got to sit on them. And after Dodd-Frank came around, after the last recession, they actually get pretty hit hard on their balance sheet for keeping these, if they want to keep these loans. And the result is you have these hard money lenders around the country. They're making these loans to these borrowers, these flippers.
So at 8 to 12%, well, what's the incentive by the hard money lender to sell you the loan?
Yeah, absolutely. So these groups typically have a limited amount of capital. When you're talking about banks, they've got deposits. These guys typically have a fund behind them. And so when they actually make those loans, they're charging 1 to 2% up front. They get to keep that. So when I go in and I buy their loan off of them, they get to loan that money out again and again and again. And they'll make those points up front, but I'm coming and taking the interest payments along the way. That's where our relationship works pretty well.
Okay, and so how are you compensated then?
So what we do is take a simple 1% management fee for invested capital. So once a client comes to us, we're not charging until we actually get their money into specific loans. Once they're invested, it's a simple 1% annualized AUM fee, and we only take our fee when our clients actually get paid. So we're very aligned with our clients.
So let's see if I understand this correctly. There is what I would call a shadow banking industry. Is that accurate?
That's fair.
Okay.
That's fair to say.
There's a shadow banking industry that is making loans, and they're making loans to whom?
Typically what you might call flippers. And so these groups are doing two things. These are professionals here that are buying a home, typically rehabbing it, and either selling it or holding it as a rental property. And so one stat that a lot of people don't realize is the housing stock in the U.S. is pretty old. Actually, almost 60% of the homes in the U.S. today were built before 1980. And so a lot of these homes are good homes, but if you can imagine your parents moving out of one of these homes, when they do, it often needs new paint, new carpets, maybe a new kitchen, new bathrooms. So a lot of these touch-ups are pretty low maintenance. So these are fairly low rehabs. They're completed within 3 to 4 months. The home's put back on the market, and they're often in and out of one of these projects in about 6.5 months, which is the average in the industry today.
So are these typically contractors? Are they speculators? Are they buying these in foreclosure, or are they just buying them at open market?
That's a good question, Charlie. They used to buy them in foreclosure, but these days there's enough demand in this market that you're seeing less of that happen. What they're trying to do are what are called pocket listings. Often they've got good relationships with real estate agents who cover a certain neighborhood that they're very interested in. These are people that are doing multiple projects at a time, and certainly multiple per year. So what they're trying to get is a look at that property before it goes out on the market, where they can quickly come in and purchase that property. They're usually a contractor. If it's not both partners, one of the partners in one of these companies might be a contractor, because that's really where you want to make the money. If you're not the one swinging the hammer, that person's probably taking your profits. So oftentimes they're contractors.
Okay, so these hard money lenders have now loaned money to this contractor or semi-developer partner, and you guys come in, you know these hard money lenders, they have an incentive to sell because now they can be compensated 1 to 2%. They can get their money back, and then they can loan it out and make 1 to 2% again. And so you go in, and I guess you cherry pick their loans, and you decide which one or ones you're willing to buy. Is that the case?
That's exactly the case. And before we're even doing that, we're underwriting that lender just to make sure we want to work with them. We need to understand how they look at the world, what type of loans they do. Does their credit box line with ours? Because if they're doing loans that we don't like, we're simply not going to work with them.
Okay.
And once we have done that, Charlie, then we're looking at the individual loans. And today, we actually say no to about 9 out of 10 loans we review. So our bar is pretty high.
Okay, and these are diversified here throughout the country. Okay, and your investors, who are your investors here? Are they institutions? Are they high net worth people? This is accredited investor stuff, right?
Correct. So the bar has to be being an accredited investor because this is a private placement. This isn't a security that we're actually registering. So the SEC mandates that. That's not our choice. And so we've got a handful of those, but we're actually getting more and more institutional investors these days. Given where fixed income is these days, anyone can open the paper and see what treasuries are returning or what bonds in general are returning. It's pretty low. So we've had more and more, even investment banks approach us about the ability to invest in these loans through us. So we've really got a variety of investors at this point.
Okay. We need to take a short break here. This is very interesting. When we come back, let's talk about how you guys are prepared to handle challenges when things go wrong, because we all know that foreclosures happen and things can and do go wrong. Again, we're talking with Ray Sturm, co-founder and CEO of AlphaFlow, and we'll be right back.
All right, time for our tip of the week with Charlie Wright. Who have you got with you today, Charlie?
Paul, we've got Tim Plain, editor of the newsletter The Dividend Hunter by Investors Alley. Tim, thanks for joining us.
Hi, Charlie. Glad to be here.
Tim, you published The Dividend Hunter to recommend high dividend paying stocks, BDCs, and REITs. Tell us right now, what tip do you have for us today?
Today I'd like to talk about a master limited partnership, an MLP called NGL Energy Partners, stock symbol NGL.
Okay, and why do you like them?
I'm looking at this as kind of a turnaround play. It's one whose share price has fallen from almost 26 down to under $14, and it's all because the company had announced dividend increases later in the year, and then a few weeks ago they announced they wouldn't be increasing the dividend until next year, and the market kind of hammered it, but it's still a pretty good company.
Okay, and what kinds of criteria tell you that you like them as a company?
You know, they're kind of a hodgepodge of different energy infrastructure assets, and they have a tremendous amount of upside cash flow potential as energy production growth in like the Permian and out west grows. So they've got some built-in growth coming, and while you're waiting, you have an 11.5% dividend yield you can earn along the way.
Okay, so what was that ticker symbol again?
It's NGL.
Okay, and for those who would like to know more, where can they go, Tim?
For my personal newsletter, it's the Dividend Hunter, and I'm sponsored by InvestorsAlley.com. If you go to the InvestorsAlley.com website, you can find all the information about my services.
Okay, and they can communicate with you?
Yes, they can.
Okay, Tim, thank you very much for joining us today, and happy dividend hunting here.
Thank you, Charlie.
All right, back to Charlie and his guest.
Thank you, Paul. Again, we're talking with Ray Sturm, co-founder and CEO of AlphaFlow, providing income-producing real estate loans to investors. So, Ray, with the question I raised before the break here, things go wrong. They just do in life. How are you guys prepared to take over properties in multiple different states where you don't have experience? Do you guys know how to do asset management, distressed asset management? Tell us about it.
Absolutely, Charlie. And it's key understanding that. A lot of lenders actually aren't in a great position for that. And really, if you're taking care of your investors' portfolios the right way, you need to think about every scenario and not only how to protect them, but ideally how to actually profit from those scenarios as well. So our approach to that is, even though we're national, we focus on trying to cluster our investments in 10 to 12 markets that we really like around the country. And those may shift over time, but the idea there is a couple of things. One, we're going to get to know those markets better and those lenders. So we're going to have a better underwriting eye for those markets. We'll understand trends and see those things. But when markets change and things shift, let's be honest, things are correlated. So if something goes wrong in Charlotte, we're probably not having one house go into default. We may have a lot of homes go into default. At that point, one thing that's different here than the Great Recession is we're not necessarily losing all these homes. We actually, to your point, we become asset managers. We become owners of those homes because the flippers may lose those to us. By being clustered, we've actually found two different things that can happen. One, it's easier to manage those properties through local property managers who can find renters at that point. Typically in those sort of economic cycles, people go from being homeowners to home renters, and so we're in a good position to fill those homes and manage them. The other thing we found is there are a number of institutional buyers for residential real estate, particularly in down cycles when they can get better prices. And by being clustered, we can offer a portfolio of homes rather than a single home to one of these buyers. And one of the ways that we can protect ourselves in that position where we can actually sell at a lower price than maybe the original flipper had hoped is we've got pretty conservative LTVs, or loan to values. So our average LTV today is about 69%. That leaves a lot of equity cushion for selling below the target price and actually protecting our investors 100%.
Okay, appreciate that. So a question we'd like to ask all of our guests, Ray, what keeps you awake at night?
Yeah, for me, in this industry, it's new enough. You referred to fintech, and that's something that's new in the industry. You worry about fraud. It's really what you always have to look for, and it's one of the reasons. We've got a very high underwriting bar. Before we're even looking at loans, we have to look at lenders. And when you're this new in an industry, if there's fraud with one player, that really is going to hurt the whole industry. You get painted with that brush. And so, like everything, the thing you fear most is what's out of your control, and it's another player in the space, really not playing by the rules.
Okay. And one final question here, Ray. How do you see rising interest rates impacting you guys?
What's been interesting about this industry, the hard money industry, that it's shadow banking, as you mentioned, is it hasn't been that correlated typically with national interest rates. What we've typically seen is as rates move up and banks charge more, our lenders basically charge more. So our net spread actually tends to stay pretty consistent between those. So it doesn't affect us very much. Candidly, one of the reasons why our borrowers are going to these lenders that they work with isn't just the rate, it's the speed of execution. So we were talking earlier about how they source homes. Well, they're not going to get the loan and then going to apply for the house. They often need to show up with cash. And so the speed that they can move with, even with a higher interest rate, keeps this very interesting for the borrowers that ultimately take out the loans that we're buying. And so I think we're in a fairly stable position.
Ray, we've heard that point several times over especially the last couple of months in our various interviews that the shadow banking industry, the hard money lenders are getting bigger and stronger because they can deliver quickly and banks just can't. So give us your website and contact information for those who would like to know more.
Great. If you'd like to learn more, we're at alphaflow.com. That's ALPHAFLOW.com. And if you want to reach out to us, you want to talk to myself or any of our investment experts on the team, you simply reach out at invest@alphaflow.com.
So final words for our listeners here, Ray.
So if I can just impart, for most investors, they think of diversification really as meaning a variety of stocks and bonds in their portfolio. Those are great. I have those in my portfolio. But I'd like to add that more sophisticated investors, they'll also include alternative investments. This should add more diversification. And really what that means at the end of the day is you should improve your returns while actually reducing your risk. So obviously I'm a fan of AlphaFlow, but I would encourage your listeners and investors in general to really take a look at alternatives. There are a lot of great ways to improve your portfolio beyond when you get just a little bit beyond simple stocks and bonds.
You're speaking our language here, Ray. That's what our whole show is all about alternative investments. So thank you very much, Ray, for joining us, and our best wishes to you and Adipedia and all those involved at AlphaFlow for continued success here. Thank you for being with us today.
Thanks so much, Charlie.
Again, we've been talking with Ray Sturm, co-founder and CEO of AlphaFlow, providing income-producing real estate loans to investors. You've been listening to Strategic Investor Radio on OC Talk Radio. Please contact us at info@strategicinvestorradio.com and go to our website to hear podcasts of all of our interviews and shows, strategicinvestorradio.com. I'm Charlie Wright, wishing you all an enjoyable week and productive investing.
Strategic Investor Radio is a production of OC Talk Radio and is provided for educational purposes only. Content of this program and the views of the guests should not be considered as recommendations by OC Talk Radio or investment advice from the host Charlie Wright or any other entity attached to this production. Investors should always consult qualified financial, investment, tax, or legal professionals prior to investing.